We know that build-to-rent developments are gaining a lot of interest and traction from property developers in the US and the UK. Can you explain what it is and if we're seeing these models here in Australia yet?
Build-to-rent, or multifamily as it's known, especially in the US, is essentially high-density residential development designed and constructed with the intention of it being held in one line. It's been traditionally developed in the US as an asset class over quite a number of years now, decades in fact, it's taken to get to the level of maturity as to where it's at now. Certainly in relation to, or comparatively speaking, our asset class as a build-to-rent asset class is very embryonic. We just haven't had the ultra-high net worth families that have been investing in this asset class, building the asset class, building its track record in terms of resale and valuation and yield and performance that the Americans have had, and more recently obviously in the UK as well. So we're very early phase here in Australia, but certainly there is a genuine enthusiastic call for the asset class to be developed further.
How is the Australian market different when it comes to build-to-rent?
Yeah, I think the Australian market is different in the fact that it is quite immature. Largely what it comes down to is predominantly what drives commercial property development is ultimately gearing, debt. The challenge with build-to-rent asset class in Australia is we don't have a resale history of products that have been specifically built on a commercial basis for commercial yield. And that ultimately leads to a lack of ability to be able to create mortgage security and value the mortgage security, because there is an unknown level of saleability, liquidity, selling period, and ultimately the product hasn't been tested in anywhere near the way that it has been for decades in the UK and the US. The Australian property development industry is far more speculative than certainly is what's in the US. I think what's apparent is that the US and UK capital markets are so deep, and the level of intergenerational wealth that take a defensive view with building build-to-rent is a passive yield, defensive yield with a very long-term view, very patient capital. And that's ultimately what is, those things are the differences as to where we are here in Australia. We simply don't have those same characteristics. And I think the only market that's going to, or the only capital base that's going to be able to build the asset class here is going to be institutional capital that has that long-term passive rates of return, low rates of return on equity, compared to what Australian property developers would have as a hurdle rate on their capital, which would be sevenfold the returns that build-to-rent can possibly generate.
What other innovative models like build-to-rent should developers here be looking at?
I think the models where I have seen build-to-rent be successful is where there is a combination of build-to-rent and build-to-sell inside of the same project. Ultimately, the ability to be able to reduce debt and to be able to secure bank finance if you're able to pre-sell a component of the development, perhaps up to 100% of the debt, and then hold the residual stock with some reasonable low-cost term debt is a good strategy where you can combine the two to achieve ultimately a build-to-rent outcome. It might not be across the total development, but ultimately you're achieving that outcome. And I think one of my most successful clients typically have a goal where if they can hold enough of the residual stock in build-to-rent, ultimately, to achieve enough positive cash flow in their group to fund their operational overhead, to fund their early works, to fund their design and approval costs and the seed capital costs associated with building a development pipeline, where they can achieve that point out of the net free cash for the assets, the passive assets that they own, which in some cases is residential stock, is a worthwhile goal. number of them have partnered with groups like Quest and others, where there's also the potential of a head lease, or a head lease with a base rent with an ability to secure an income stream over and above a turnover rent, which gives them a little bit of upside in the yield of the property as well. The other model, which I think is quite attractive at the moment, is manufactured housing estates targeted towards the retiree market. And manufactured housing estates have certainly come a long way. No longer are they essentially rather shabby-looking mobile home cabins that we would associate decades ago. They're very attractive, modern houses now that are technically able to be relocated, but for all intents and purposes, they're slab on ground, and there's very attractive, architecturally designed, appealing product towards that retiree market. Ultimately, they're paying a ground lease, a relatively affordable ground lease, and they own the house. Typically, they're cash buyers, which means that they don't have the challenges and the problems associated with financing at the moment for purchasers. Banks are readily able to take on minimal deposits as pre-sales, and as long as the developer has got the equity to fund the central facilities up front, then typically that will encourage a sales rate in most of the locations where I'm seeing them being developed and advising my clients in the markets where they're being developed, to the point where projects that are being forecasted to take 6 years on a sales rate are selling out in half that time. What I like about that product is there's the development profit that's made on the construction and the sale of the houses. And typically, as you work through a staged residential development, you'll have a diminishing land value as you progressively build and sell the land out. What I like about build or manufactured housing estates is that you end up with the same value in terms of the land that you've developed, because there's an income stream that's available through the land lease and through the management of the grounds and management of the essentially of the body corporate, so that you have an income stream from what you've developed, take the development profit to the point where you can have your cake and eat it too.